You may have seen the 20% decline for UnitedHealth Group a few days ago after the earning release, and it's a company that I've been following for years, and I invested a year ago in the company to sell like right after, like 3 or 4 months after. I sold immediately my position, and I will explain you why in this video, and I will also explain you why I don't like this company. I don't feel it can be a good idea to invest regardless of the good number, because the number I kind of find for this company, it's a great compounder, but you will understand in this video why I don't invest, and we'll do also valuation to see at which valuation it can be interesting if you still want to invest in this company. So as you can see, the share price have been like really skyrocketing. It's really a great company. Like it's 415 billion. If you compare to S&P 500, okay, it underperformed for the last 5 years, but if you take for the last 10 years, it's significant outperformance, like almost 3 times better, and last 15 years, like 2000%, like really a great compounder. It's a company which have a revenue growing like significantly. You look at total revenue, in the last 10 years, it has been growing by 11% per year, which is great. And it's supposed to grow for the future, okay, by around 10% per year. Like it's a company that keep this 10% per year revenue growth. So it's extremely good. When you look at the net income, it's same, great growth. You have this little one down here in 2024, but now it's back up. 15% net income growth, okay, and it's supposed to continue this way in the future, okay, with 16% growth for the next income. So the net income expected for the next 3 to 4 years. The share outstanding, they've been doing some buybacks. It's not the biggest buyback company, but they do some, like minus 0.4%. Okay, you have a little buybacks here. If you start from here, you can have almost minus 1%. So the company is doing a bit of buybacks. You have operating margin that are growing, okay, they are 7%. Now they are 8.2%, especially since they have Optum. Optum really helped the company to accelerate, plus to have better margin. Because if you look at the margin from Optum, okay, here, you have 16% margin, almost 20% in some years, but 16%, 15% for the bad year. So it's a really good operating margin business, plus it's a part which is growing significantly, okay? If you look at it, it's growing by 16% per year. So it's a great area. It's expected to grow, to continue this growth and even accelerate this growth. So yeah, it's a great business. Like, let's be fair, it's a great business. But the problem here, the problem that I see and the reason why I don't invest in this company is because even if it's a great business in terms of numbers, I don't feel it's a great business in terms of customers. There is so many stories about customers unhappy with this company. So you will tell me, yes, but it's healthcare, it's insurance. So nobody is happy with insurance. Like you don't have a single customer which is happy with insurance. The problem here is with UnitedHealth. I've been listening to some doctors' podcasts. I've been talking as well with some doctors, like health professionals, about their client, about the fact that some have UnitedHealth Care and so on. And the problem here is like so many people are just trapped with UnitedHealth because they don't have the possibility to use another provider because they are trapped, because their employer want to use UnitedHealth Care because they have better pricing or whatever. So they are trapped with this. That's the problem number one. The problem number two is that they did some tests with different patients, with different healthcare provider. And during those tests, they just realized that it was way easier for people to get refund from other service providers, from other healthcare providers and from UnitedHealth. And I'm suspecting UnitedHealth to make more money than the other one, to have a bigger market share, because they're, I will not say scamming their customer, but they're playing on the fact that the customer will not try to get their money back, will not do whatever they can do to get the money back. And the ones that want to do and want to have their money back, they will manage to have it at some point, but they will be struggling so much. I really recommend you to do some research, to listen to some podcasts of some doctor explaining all of this. But you have a lot of them explaining that, yeah, when I have a patient and it's United Healthcare, for me it doesn't change anything because I get paid up front, so I don't care. But they need to receive the refund. So when I will send the notice, no problem with all the other one, but with United Healthcare, I will have a problem. They will not get a refund. They will need a bigger step to get a refund. Sometimes I will even need to sue them to manage to get the refund. So it's not viable because nobody's tried goes that deep to get this refund. So when it's $10,000, yeah, people will fight for it. But when it's $100 here, $300 here, they will try for a week. After a week and 20 emails, 5 phone calls that they will tell you, okay, go here, go here, go here. They will just be like, yeah, okay, I will not waste my time anymore for $300. Okay, so this is something that I really don't like, and I'm not saying that this is the reason of the success of this company, but it's the reason why I don't want to be a part of it. Okay, there is so many other great companies. I don't need to be invested in everything. I don't need to own any healthcare provider, even though you have great numbers. If we look at charting and we compare with competitors like United Health, Elevance, and Humana, okay, which are, let's say, the 3 main competitors in here. If we want to look at, let's check the margins, okay? Let's take operating margins. If you compare operating margin, United Health is over the other one, especially thanks to the Optum acquisition, but United Health is higher than the other one. If you look at gross profit margin, it's Humana is a bit higher, and then they are both very close. You just have Humana a little bit higher. When you look at return on invested capital, this was a return on invested capital. It wasn't gross profit. It was return on invested capital. You have Humana a bit higher, and Elevance and United Health on the same level, kind of the same level. So yeah, this is some element that I find good. Like the numbers, let's not lie, they are not bad. For me, the return on invested capital is a bit low, but they are not bad. It's just the main reason is the way they treat their customer. I don't like this. I don't like business that are not customer friendly, that don't make life easier for their customer. Okay, I really don't like this. Maybe I got biased. Maybe all the people to who I talk were the only ones that really have problem with this. But at some point, the things that they were explaining, it really doesn't seem that they are the only one. It's a bit the same with PayPal. Okay, I don't like this company PayPal because I use PayPal every day, and I hate this. I hate the fact that I have approximately 10 to 12% fees when I receive a payment and when I want to transfer this money into my bank account. The total fees that I will pay will be around 10 to 12%. I don't like this. I don't like that my money sometimes is held. I don't like that I cannot do a transfer without calling them or things like this. So yeah, that's reason why I don't like this kind of business. So now let's go to valuation, okay? So here with my DCF calculator, we'll do a 5-year projection, okay? Let's imagine the net income will grow by 10% per year. It's very, okay, here we take a lot of margin of safety. If we have 1% buybacks every year and a P ratio of 22 in 5 years, okay, if the fair value, if you want to do 13% per year, would be $399. But now we saw that they are growing way faster than this. Okay, they are growing way faster than 10%. The net income is growing by around 15%. Plus, let's check rapidly the average or the median price earning. So the median price earning for this company is 22 and a half, and the average 23. So we'll put 22. 22 is good. Let's now put this at 0.5. Okay, they do 0.5 buybacks, and it will grow by 15%. If it grows by 15%, the fair value will be $433. Okay, with the last net income, $433 to do this 13% per year. Now, if you buy at this price, you will do approximately 12% per year with dividend. So if you want to do 13, yeah, you need either to buy at 433 with this growth rate, or to have 16, 17, yeah, approximately 17%, 16.5. 16.5% growth rate to do this 13%. So the value is not too much overvalued. Like if you take 13% like this, you have some margin of safety. You need still like the stock to decline by 12%. So it's the value, it's kind of fine. The number are good. Okay, the number are good. They are not perfect. We would like business with higher margin, but seeing the growth of Optum and the margin of Optum, like it's tend to go there. So this is fine. The return on capital, okay, are good. Okay, the return on invested capital is a bit low, but return on capital employed and return on equity are good. So most of the metrics here are good. It's a good business. The only problem is I don't like how they treat their customer. For you, it doesn't mean that for you should not invest in it. I'm not saying don't invest in this company. I'm just saying that I cannot. If for you it's fine the way they do, or you think that maybe I'm wrong and they treat the customer seriously and they do business honestly and so on, okay. If you think like this, you may invest because it may be interesting. It's still a bit expensive, okay, but we're around $400. I think it can be a good opportunity for you. So let me know in the comment section if you invest in it or not. Like I will be interested to know your view on it and your position for this.